A hotel chain, your name above the door, guests every night. Let's talk about what actually happens. Not the brochure version, the real numbers, the ones that weren't in the pitch deck. We're going to follow the money, all of it, starting the moment you sign. Your 200-room hotel sits on 3.2 acres. The guest sees about 40% of the building. The lobby alone costs $800,000 to renovate properly. You'll do it twice in your first decade. Right now, 68 of your 200 rooms are booked by corporate accounts at a discounted rate. The restaurant seats 80. It ran at a $94,000 loss last quarter. You just bought that loss. The conference center fits 300 people. It was empty 19 of the last 30 days. The parking structure holds 220 cars. Managing it costs $180,000 a year. Behind the guest floors, laundry, storage, engineering, staff rooms, you own all of it. The purchase agreement was 340 pages. Your lawyer flagged 12 issues. You closed anyway. The franchise agreement runs 20 years. Early exit costs $1.2 million in penalties. Brand standards, quarterly audits. 3 consecutive failures terminates your license. Page 47 of the franchise agreement, property improvement plan, $4.2 million in upgrades, 36 months. You also inherited 6 active lawsuits. Employment disputes, a slip and fall, 1 contract breach. The previous owner had 14 active vendor contracts. You assumed all of them on closing day. Mortgage assumption, $12.4 million at 6.8% interest. Monthly payment, $91,000. Day 1. The booking system goes down at 7 a.m., 40 check-ins expected by noon. Weekend staff didn't get paid last Friday. Previous owner's payroll error. It's your problem now. A corporate client calls. They want to renegotiate their rate. They're worth $380,000 a year. The head housekeeper quit. She was the only one who knew the linen ordering system. The kitchen needs a new hood system. Health inspection is in 11 days. Cost $34,000. 3 guests left 1-star reviews overnight. 2 are legitimate complaints. The first real P&L arrives. The previous owner's numbers were not what you were shown. Actual EBITDA last 12 months, $340,000. You were shown projections of $680,000. This is not a passive investment. This is a business. It requires a full-time operator. Every day the hotel is open, 200 operational decisions are made. You are responsible for all of them. The good news, the asset is real. Bricks, rooms, infrastructure. It doesn't disappear overnight. You are now an employer, a landlord, a brand licensee, and a debtor simultaneously. Day 1 ends. You handled 9 crises. Tomorrow starts at 6 a.m. Welcome to ownership. Day 2. The system is back online. 3 new problems have replaced the 9 from yesterday. This is the rhythm. Every morning, the hotel wakes up before you do, and it needs things. The hotel doesn't stop generating obligations at 5 p.m. It doesn't take weekends off. There are 180 people on your payroll. They showed up this morning whether you did or not. Before your first coffee, $3,100 in fixed costs have already accumulated. Every morning. Now let's talk about who actually runs this building, because it isn't you. You are the owner. That means you sign things and you are liable for things. That's most of it. The person who runs your hotel is your general manager. You need to understand this person completely. A great GM can make an average hotel profitable. A poor GM can destroy a great hotel in 18 months. The average hotel GM earns $95,000 to $140,000 per year. The best ones earn more. GM turnover rate in mid-scale hotels, 28% per year. You will replace your GM. When you do, occupancy drops an average of 8 points during the transition. Plan for it. Below the GM, a director of rooms. They manage front desk, reservations, and housekeeping. Below that, a revenue manager. Their job is to price every room, every night for maximum yield. A good revenue manager adds $180,000 to $340,000 in annual revenue. A poor one costs you the same. The director of food and beverage oversees the restaurant, bar, room service, and banquets. Your F&B director manages a department that is almost certainly losing money. That's industry normal. Hotels keep restaurants because corporate clients and conference bookings expect full-service amenities. The director of engineering maintains your physical plant. HVAC, plumbing, elevators, electrical. Engineering failures are unpredictable and expensive. Budget $280,000 per year for unplanned repairs. The director of sales drives group bookings, corporate accounts, and event revenue. Without a strong sales director, you are 100% dependent on OTAs. That's a dangerous position. The director of finance oversees your accounting, payables, receivables, and monthly reporting. Your finance director is the person who tells you the truth. Listen to them. Below each director, department heads, supervisors, and frontline staff. 180 people total. Each of those 180 people has a contract, a schedule, a wage rate, and an HR file you are responsible for. You are not managing people. You are managing systems that manage people. There is a difference. If you try to manage daily hotel operations yourself without hospitality experience, you will fail faster. The machine works when the right people are in the right seats. Your job is to make sure they are. Act 2 begins. The machine is running. Now let's look at what it costs to keep it running. Act 3. The numbers nobody shows you. This is the part of the business that surprises every new owner. The brochure said $4.1 million in annual revenue. The reality is more complicated than that number. Revenue in a hotel is not what guests pay. It's what you keep after the costs attached to that revenue. The metric that runs your business is RevPAR. Revenue per available room. Learn it before anything else. RevPAR equals your average daily rate multiplied by your occupancy percentage. Simple formula, hard to hit. At 200 rooms, a RevPAR of $100 generates $7.3 million in annual room revenue. That's the ceiling calculation. Your actual RevPAR in year 1 will be lower. Industry average for mid-scale, $78. Target, $95 to $110. Every dollar of RevPAR gain on 200 rooms is $73,000 in additional annual revenue. It compounds. Occupancy is the other half of the equation. You need to understand what drives it and what destroys it. Average mid-scale hotel occupancy in the U.S., 64%. Top performers hit 78 to 82%. Your break-even occupancy point, approximately 58 to 62% depending on your cost structure. Below 58%, every available room is costing you money even when it's empty. The myth of the empty room. A vacant room still costs $22 to $35 per night in fixed allocated costs. You cannot simply close unused rooms to save money. The costs are structural, not linear. Occupancy is built through 3 channels: direct booking, corporate accounts, and OTAs. Direct booking costs you almost nothing in commission. It's your most valuable channel. It's also the hardest to build. Corporate accounts provide predictable volume at negotiated rates. The rates are usually 25 to 35% below rack. OTAs, Booking.com, Expedia, Hotels.com. They fill rooms. They also take 18 to 25% of each booking. On a $150 room night, an OTA commission is $27 to $37. On 40 bookings a day, that's $400,000 per year. $400,000 per year paid directly to Booking.com or Expedia. This is not an optional cost. This is how the industry works. The OTA's algorithm rewards volume and competitive pricing. The more rooms you give them, the better your placement. Better placement means more bookings. More bookings mean more commission. This is a dependency loop. To escape the loop, invest in your direct booking channel. Loyalty program, direct booking incentives, brand website. Breaking OTA dependency takes 18 to 36 months and meaningful marketing spend. Most owners underestimate both. Corporate account management is a full-time sales function. You need a sales director dedicated to this. A mid-scale 200-room hotel should target 30 to 40% of revenue from direct and corporate combined. If that number is below 20%, your OTA dependency is at dangerous levels. Group and event business is the third revenue pillar. Conferences, weddings, corporate retreats. Group business requires a functioning sales team, competitive meeting space, and reliable F&B execution. You now have a clear picture of where revenue comes from. Next, where it all goes. Now the expenses. This is the section that reframes everything you thought you understood about hotel margins. Labor is your single largest expense. In a mid-scale 200-room hotel, it runs 32 to 38% of total revenue. On $4 million in revenue, labor alone is $1.28 to $1.52 million per year, every year. Breaking it down, housekeeping $1.4 million. Front desk and management $980,000. Engineering and maintenance $620,000. F&B labor adds another $640,000. Security $380,000. Total payroll, including benefits, $402 million. Wait, $4 million in labor on $4 million in revenue. That's the trap in the numbers. Total revenue is not the same as room revenue. Your hotel also generates F&B, event, and parking revenue. Full-service 200-room hotel realistic total revenue, $5.8 to $6.4 million annually when fully optimized. At $6 million total revenue and $4 million in labor, your labor efficiency ratio is 67%. Industry average is 35 to 42%. This means you need to optimize, reduce F&B scope, cross-train staff, renegotiate with housekeeping vendors. Housekeeping cost control is the highest leverage operational improvement available to a new owner. Shifting 40 rooms from full service to opt-in housekeeping saves $180,000 to $260,000 annually. Next, franchise fees. Your franchise agreement charges a royalty on gross room revenue, typically 5 to 7%. On $3.8 million in room revenue, the royalty is $190,000 to $266,000 per year, non-optional. Additionally, marketing contribution fee of 1.5 to 3%. Reservation system fee of $4 to $8 per booking. Total franchise cost annually $380,000 to $520,000. This is the price of brand recognition. Property taxes vary by location. In a mid-market urban location, expect $180,000 to $340,000 per year. Insurance, property, liability, workers' compensation, business interruption. Budget $120,000 per year minimum. Utilities, electricity, gas, water. A 200-room hotel in average climate conditions, $380,000 to $480,000 per year. Cable and internet for 200 rooms plus public areas, $96,000 per year. Guests now consider this non-negotiable. Linen and supplies, towels, bedding, toiletries, cleaning products, $180,000 per year minimum. Marketing beyond the franchise fee. Google Ads, social media, local partnerships at $120,000 minimum. Software and systems, property management system, revenue management tool, accounting platform, $84,000 per year. Debt service, your monthly mortgage payment of $91,000 is $1.09 million per year going to the lender. Capital Reserve Fund, 4 to 5% of revenues set aside for future asset replacement, $240,000 to $300,000 per year. Added all together, labor, franchise, taxes, insurance, utilities, supplies, marketing, software, debt, reserves, total annual expenses on a mid-scale 200-room hotel, $5.1 to $5.7 million. On revenue of $5.8 to $6.4 million, that leaves $700,000 to $1.3 million before owner distributions. That is your operating income. It is not guaranteed. It requires the hotel running at near optimal occupancy, and it requires that nothing unexpected breaks. Act 4 is about what happens when something does. Act 4, the nightmare. 3 scenarios that every hotel owner encounters, only the prepared survive them. Nightmare 1, seasonality. Most markets have it. Almost no new owner truly prepares for it. A 200-room hotel in a business travel market loses 30 to 40% of its bookings between December and February. In summer resort markets, it's the opposite. Winter is boom, summer is crisis. The direction doesn't matter. What matters? Your fixed costs in low season are approximately 85% of your peak cost. You cannot cut your way to safety in low season. Most costs are contractual: staff, mortgage, insurance. December, your occupancy falls to 38%. Your revenue that month, $102,000. Your fixed costs that month, $180,000. You lost $78,000 in December before anything went wrong. January is the same. February improves slightly. You've burned through $180,000 in operating losses in 90 days. You did not budget for this. The pitch deck showed annual averages. Annual averages hide seasonal reality. The fix: build a seasonal reserve fund before your first low season. Minimum 90 days of fixed costs. For your 200-room hotel, that reserve is $540,000 sitting in liquid cash doing nothing until you need it. Most new hotel owners don't have this. They take emergency loans in February at higher interest rates. Nightmare 2, the reputation crisis. One incident, social media, a review spiral you cannot reverse quickly. A couple checks in. The room has a maintenance issue. They post a video to social media. It gets 400,000 views. Within 72 hours, 180 negative reviews appear on Google, TripAdvisor, and Booking.com. Most are piled on. Your average review score drops from 4.3 to 3.1 in 1 week. The algorithm takes immediate notice. On Booking.com, hotels below 7.5 out of 10 see a 24% reduction in visibility in search results. Your RevPAR drops 31% in the following month. You lose $94,000 in revenue during the crisis period. Recovery takes 4 to 6 months of active reputation management, incentivized review campaigns, and operational fixes. The cost, $340,000 in lost revenue plus $45,000 in professional reputation management and marketing. The prevention, a proactive in-stay feedback system that catches issues before checkout. Most hotels don't have one. Nightmare 3, the franchise renovation mandate. This one hits without warning. Relative to the calendar it's scheduled, it still surprises people. Year 7, your brand does a product audit, your property scores below the required standards. The franchise sends a property improvement plan. Your lobby, corridors, and 40 rooms must be updated. Estimated cost, $1.4 million. Timeline, 120 days. During construction, your sellable room count drops to 160. With 40 rooms unavailable for 4 months, you lose approximately $290,000 in room revenue at normal occupancy. Total renovation impact, $1.4 million construction cost plus $290,000 revenue loss. $169 million event. You knew this was possible. The franchise agreement mentioned it. The timeline was just not clear to you. Hotel brands do mandatory property improvement plans every 7 to 10 years. Plan for them from day one. The Capital Reserve Fund discussed earlier exists precisely for this. $240,000 per year over 7 years is $1.68 million. The owners who survived Nightmare 3 are the ones who funded the reserve. The others take distressed debt. Act 5, the exit. Most hotel owners will sell. The question is when, how, and how much they actually keep. The decision to sell rarely comes from strength. More often it comes from exhaustion or opportunity. Exhaustion exit. The owner has managed through 2 nightmares, 3 GM changes, and a renovation. They're done. Opportunity exit. The market has compressed cap rates. A REIT is acquiring in your submarket. Time to move. The ideal exit timeline is year 5 to 8. Long enough to stabilize operations, short enough to avoid the next major renovation cycle. Year 3 is too early. You haven't yet proved stabilized performance to a buyer. You'll leave value on the table. Year 10 is often too late. You're approaching the next PIP cycle. Buyers will discount for the upcoming CapEx. To sell a hotel, you need a trailing 12-month operating statement that shows consistent performance. A single bad year in your trailing period drops your valuation by more than the operating loss itself. Buyers underwrite risk. 1 weak year suggests operational fragility, the multiple contracts. Hotel valuation method 1, cap rate. Net operating income divided by the cap rate equals value. Cap rates for mid-scale hotels in secondary markets, 7 to 9%. Primary markets, 5.5 to 7%. Your NOI of $900,000 at a 7.5% cap rate puts your property value at $12 million. Hotel valuation method 2, EBITDA multiple, 8 to 12 times EBITDA, depending on asset quality and market. Your EBITDA of $800,000 at a 10x multiple, $8 million. Same hotel, different method, different number. Buyers use whichever valuation method produces the lower number. Know both before you negotiate. Who buys hotels? 3 types of buyers dominate the acquisition market. REITs, real estate investment trusts focused on lodging. They buy stabilized assets at or near full value. Private equity, acquisitions funds seeking distressed assets or value-add opportunities. They buy below market. Individual operators, experienced hoteliers expanding their portfolio. They know exactly what your problems are. If your hotel is performing well, target REITs or institutional buyers. If it needs work, expect private equity. The selling process: hire a hotel broker, not a general commercial real estate agent, a hotel specialist. The broker prepares a confidential information memorandum. This document is the story of your asset. Qualified buyers submit letters of intent. You negotiate price, terms, earnest money, and due diligence period. Due diligence: 60 to 90 days of buyer inspection of your financials, operations, physical plant, and contracts. During due diligence, surprises reduce price. Clean books, organized records, and maintained systems protect value. Closing: typically 120 to 180 days from signed LOI. Your franchise agreement requires brand approval of the buyer. Net sale proceeds: the sale price minus your remaining mortgage balance, minus broker commission, minus closing costs. Broker commission on hotel transactions: 1 to 3% of sale price. On a $12 million sale, up to $360,000. You bought for $22 million, including renovations. You sell for $12 million after 8 years, minus mortgage paydown. Mortgage paydown over 8 years at $91,000 per month, approximately $3.6 million in principal reduction. Your equity recovery: $12 million sale minus $8.8 million remaining mortgage equals $3.2 million. After broker fees and closing costs, approximately $2.8 million returned, plus 8 years of operating income distributions. If you took $600,000 in distributions over 8 years, total return $3.4 million on a $3.5 million equity investment. That is a 97% return over 8 years, about 8.7% annually, barely above your cost of capital. Act 6. The verdict. You now have the full picture. Let's be direct about what it means. Owning a hotel chain is not a wealth-building strategy. It is an operational business that happens to own real estate. The difference matters. Wealth-building strategies are passive. Hotel ownership is not passive, not even close. The investors who make real money in hotels are not the operators. They are the lenders and the brands. The lender collects interest on $12.4 million for 25 years regardless of your occupancy. The math always works for them. The brand collects royalties, marketing fees, and reservation fees on every dollar you generate. They never have a bad year. You collect what's left after everyone else has been paid. In good years, it's meaningful. In bad years, it's negative. Here is what the successful hotel owners have in common, without exception. First, they had prior hotel operations experience before owning, not adjacent experience, hotel-specific experience. Second, they bought with sufficient equity. The over-leveraged buyer is the most common hotel failure story. Third, they had a 7-year minimum plan from day one, not a 3-year flip, not a 5-year stretch, a real 7-year commitment. Fourth, they built their management team before they closed. The GM was hired, the revenue manager was vetted. Fifth, they funded the reserves: seasonal reserve, CapEx reserve, operational reserve, all three before needed. Sixth, they treated it like a business, not an investment. Quarterly reviews, KPI dashboards, active management. If you have all six, hotel ownership can deliver 9 to 14% annualized returns over a 7-year hold. For context, the S&P 500 has historically returned 10.5% annually with zero operational involvement. Now the honest list: who should not buy a hotel chain? The person who wants passive income. Hotels require active management engagement every single week. The undercapitalized buyer. If you need 100% debt financing, the risk-reward math doesn't work. The short-term investor. 3 to 5 years is not enough time to stabilize, perform, and exit profitably. The buyer without hospitality experience who plans to hire and trust a GM completely. GMs need oversight. The person who sees the revenue line and ignores the cost structure. The gross revenue number is not your income. The person who thinks location alone drives success. Market matters, but operations determine the outcome. Hotels are not apartments. Apartments have leases. Hotels resell every night. The machine never stops. Every empty room tonight is revenue you will never recover. The clock runs continuously.